spousal registered retirement savings plan, RRSP, allows a spouse with earned income and contribution room to contribute to a plan in their partner's name, even if the partner has no earned income and therefore no contribution room of their own. This can be an effective strategy for income splitting, which helps reduce a couple's overall tax burden. Key benefits of a spousal RRSP. Tax reduction. By contributing to a spousal RRSP, the higher earning spouse can move their contributions from their high marginal tax bracket to their partner's lower or zero tax bracket. This strategy allows the couple to save on taxes when the money is eventually withdrawn in retirement. Avoiding old age security OAS clawbacks. OAS is subject to a clawback of 15% for every dollar an individual earns above a certain income threshold, which was roughly $73,000 to $74,000 in the provided example. By splitting retirement income, both spouses can keep their individual incomes below this threshold, ensuring they both receive the full OAS benefit. Contribution rules. Contributions to a spousal RRSP reduce the contribution room of the contributor, the spouse with the earned income, not the plan holder, the spouse receiving the contributions. For example, if a spouse with $37,000 in contribution room puts all of it into a spousal RRSP, their own contribution room is reduced to zero, but their partner's remains unaffected if they have one. The attribution rule, a major caveat. A significant rule to remember with a spousal RRSP is the attribution rule. This rule is in place to prevent the higher earning spouse from avoiding taxes by moving money to a lower taxed account and then immediately withdrawing it. If the spouse who owns the plan withdraws funds within the year of deposit plus 2 years, a total of 3 years, of a contribution, that withdrawal is considered attributable to the contributing spouse. This means the contributor gets the tax bill, even though their spouse receives the money. For example, if a spouse contributes $10,000 annually from 2013 to 2016 and the other spouse withdraws the full $40,000 in 2016, the $30,000 from the contributions made in 2014, 2015, and 2016 would be taxed back to the contributor. Only the $10,000 contributed in 2013 would be taxed in the hands of the spouse who made the withdrawal, since it's outside the 3-year window. Registered Retirement Savings Plans, RRSP. An RRSP is a registered plan designed to help Canadians save for retirement. RRSP contribution limits. Your RRSP contribution limit is calculated as 18% of your previous year's earned income, subject to an annual maximum. The lesser of these two amounts is your limit for the year. Earned income. This includes salary, bonuses, commissions, rental income, net business income, and spousal support payments. It does not include investment income like interest, dividends, or capital gains. Pension adjustments. If you have a company pension plan, you must subtract a pension adjustment PA from your RRSP contribution room. This is because your pension contributions already represent a form of deferred retirement savings. Carry forward contributions. Any unused contribution room can be carried forward indefinitely and used in a future year. One-time overcontribution. You are allowed a one-time overcontribution of up to $2,000. This amount is not tax-deductible but will grow tax-deferred. RRSP withdrawals. In most cases, any withdrawal from an RRSP is 100% taxable as income in the year it's taken out. Withdrawals made before age 71 are also subject to a withholding tax of 10%, 20%, or 30%, depending on the amount. This withholding tax is a prepayment of taxes and is credited when you file your return. There are 2 exceptions to this rule where you can withdraw funds without immediate taxation, but they must be paid back. Home Buyer's Plan, HBP. You can withdraw up to $25,000 to buy or build a first home. The money must be repaid over a 15-year period, and if a payment is missed, that amount becomes taxable income for the year. Lifelong Learning Plan, LLP. You can withdraw up to $10,000 per year, up to a maximum of $20,000 in total, to finance full-time education for yourself or your spouse. The withdrawals must be repaid over a 10-year period, and like the HBP, missed payments become taxable income. RRSP maturity. An RRSP must be converted into a retirement income stream no later than the end of the year you turn. The 2 main options for this conversion are Registered Retirement Income Fund, RRIF. A RRIF allows you to keep your investments and withdraw a minimum amount each year, with no maximum withdrawal limit. It provides flexibility but comes with market risk. Annuity. An annuity provides a guaranteed, fixed income for a set term or for life. While it offers peace of mind, it is inflexible and may not have a remaining value for beneficiaries upon death. Rollover provisions upon death. If you die, your RRSP or RRIF can be transferred to a surviving spouse or a financially dependent child or grandchild, which defers the tax liability. This is known as a tax-free rollover. If there is no eligible beneficiary, the full value of the plan becomes taxable income for your estate in the year of death.